Okay, so welcome to part 3 of 3 in this little video series for this exercise that we have here. And again, if you've watched any of the other videos, you kind of know what I'm probably going to say. The name of the exercise is Journalizing Transactions in Template, Journal Entry Form, and T accounts. And this particular third part of the series looks at T accounts, and we cannot journalize transactions without making a journal entry. Okay, we said in a previous video that the template is very good for identifying changes in stockholders' equity. The journal entries don't do a very good job of that, at least not just by looking at a bunch of journal entries. But that's what, once we post those to the GL, to the general ledger rather, that's how our financial statements get populated. Okay, so the journal entry is very, very important. And then T accounts don't really help us do a very good job of tracking owner's equity, and they certainly do not post. We don't post anything through T accounts to the accounting records, but what we can do, T accounts are useful in helping us reconcile the balance of individual accounts. And as look here, we have quite a few. Now it looks to me, like we, I'm just looking at something here. Let's see here. So it looks to me like we have mostly transactions that are not going to have a lot of entries on them, the exception being cash right here. Okay, so let's look at our scenario just briefly and then we'll get going. We're dealing with a company called Minute Maid, and we've dealt with them before. In fact, this is the third time in a row. It says this is a firm that provides house cleaning services, and they began business at the beginning of April 1st. Or they began business on April 1st, and so they had the following transactions in the month of April. Okay, so we have no account balances down here, none whatsoever. And in the again, in the journal entries, hard to get the balance from looking at a bunch of journal entries. The financial statement template doesn't list the names of accounts, so we can't get the balance that way either. But T accounts are very, very good for this. Okay, so let's look at these transactions. A Falcon, and that's a person. Call him Anthony Falcon. He's going to be the owner of Minute Maid. All right, and so he invested $9,000 cash to begin the business in exchange for common stock. All right. The other thing that I think T accounts are good for is helping us practice our normal balances, like where do we enter the increase and where do we enter the decrease on these accounts. So that's helpful, I think, too. We can do that through journal entries, and we can do it through the template as well, but this gives us another way to do that. So from the business's perspective, in this first transaction here, I'm not sure what this box is. These boxes are here, so I'm not going to worry about them. I'm just going to put in $9,000. Okay, that's what I'm going to do. And the other side of that is that common stock also went up. The amount of common stock issued by the company went up by $9,000. However, common stock goes up on the right. Okay. So as we do this, what we might do is put a little arrow up and down. Now, common stock pretty much only goes up. We won't have to deal with any situations where it goes down with a debit or on the left side. Okay. April the 2nd here says paid cash for 6 months lease on van for the business. Okay, so we're using cash, and so cash goes down on the right. And then so we will have some kind of a prepaid asset, prepaid van lease. This is also an asset account. So we can do something like this. All right. So we can put $28.50 over here on the left side because that is an asset. Where are we at here? April the 3rd, borrowed $10,000 cash from the bank and signed note payable agreeing to repay it in 1 year plus 10% interest. So cash has gone up here. So we got to enter that in over on the left hand side. Okay. And then we also have a liability that has gone up. And liabilities go up on the right and down on the left. So we're going to enter this $10,000 here. Then on April the 3rd, we're going to purchase equipment for $5,500. We're going to pay $2,500 cash, and the remainder is to be due within 30 days. So we have to do 3 things here. Okay, 3 things. So equipment is what we received. So let's see if I can actually find the equipment. Here it is. And equipment is an asset. So it's going to go up on the left and down on the right. Plot 5,500 right here. Okay, hopefully we can read that that is 5,500. Cash has gone down, so we got to enter that on the right side. And then something else has gone up, and it's this one right here. So just as note payable goes up on the right and down on the left, any payable will go up on the right. And you may wonder, okay, wait a minute, what's this $3,000? Well, equipment was $5,500 minus the $2,500 that we paid in cash gives us $3,000 that we owe on a payable. You say, well, why are we going to do this as an accounts payable and not as a note payable? Well, for one thing, they didn't give us any room to do it as an accounts payable, right? So that's kind of a hint. However, notice that we're paying this in 30 days. And note payables usually have a minimum time of about 90 days. So that's a pretty good indicator that we're correct. Okay, April the 4th. Says that we paid $4,300 cash for cleaning supplies. All right. So we paid $4,300. That means that cash has gone down on the right. And let's see here. Supplies is also an asset account. So it's going to go up on the left, down on the right. So we're going to put $4,300 right there, nice and easy on the left side. April the 7th, paid $350 cash for advertisements to be run in the newspaper during April. Okay, so cash has gone down again by $350. And let's see here, advertising expense accounts. Expense accounts actually go up on the left too, just like assets. How confusing is that? So we've got $350 here. And it makes sense because, we had to reduce cash on the right, so that's why expenses have debit balances, or one of them. April the 21st, billed customers $3,500 for services performed. Let's see here. Is that what it said? Yeah, performed. Okay. So we didn't get the money, but we got an account receivable. We have the right to receive that money from the customer. So this is an asset. And it went up by $3,500. Right? And then let's see here. So where is my cleaning fees earned? This is a revenue account, and revenues go up on the right, down on the left. So we're going to plot that $3,500 right here. April the 23rd, paid $3,000 cash on account to cleaning equipment suppliers. See April the 3rd. So we're paying $3,000 cash. Well, if that's the case, cash goes down on the right. However, accounts payable go down on the left. So we're going to enter that just like so. And if we were to reconcile this account right now, we'd see that it has a zero balance. 3,000 minus 3,000 is 0. Collected $2,300 cash from customers on their accounts. Okay. So looks like I'm probably doing this the wrong way. Didn't really follow the instructions. Always a great idea. So cash has gone up on the left side for $2,300, and then accounts receivable has gone down by $2,300. Yeah. So if we were to reconcile this account right now, we would get its true balance, and I'll show you how to do that when we get done. Okay. On April the 29th, paid $1,000 cash for dividends. So that's going to go down on the cash is down, so it does so on the right. And dividends, if we can find it here. Okay, so they're calling it retained earnings. So if you saw the video that we made before, I didn't know what these accounts were called. So this is kind of tricky the way they've got this. I actually don't care for this. Because cash has gone down, right? I would prefer that, I mean, we can still do this. I would prefer that we showed, dividends here instead of retained earnings, because this is kind of heady. This is kind of a more complex treatment of this. But retained earnings go down on the left. Equity accounts such as retained earnings and common stock go up on the right and down on the left. Now retained earnings will go down from time to time, so we're going to go ahead and put the arrow there. All right, and then April the 3rd, paid $1,750 cash for April wages. So again, we've got a deduction to cash over here on the right side. Wages expense go up on the left. And by the way, over here I put a little down arrow on the right. Expenses usually just go in one direction, and that's up. So let's see here. That was $1,750. All right. And then paid $9.95 cash to service station for gasoline used during April. All right. So another $9.95 reduction to cash. And then fuel expense, it is an expense, goes up on the left. All right, so for a lot of these accounts, and this is not, this does not appear to be a part of this exercise, but, we might as well at least look at it, because the purpose of T accounts is to reconcile the balance. And so we've got a few of these accounts that we can do. Now cash might take us some time. I might skip that one. We would say that the ending balance is 0 for this accounts pool. And notice that I put the 0 over here on the right rather than over here on the left, because this is the normal balance side of it. Now a lot of these accounts only have one entry in them. But notice receivables has a $3,500 up and a $2,300 down. So, we could put it here in this little square. I think what I'm going to do is I'm just going to put it right here. And again, I put it on the left because that $1,200 balance is a left side or debit balance. All right. And then with cash, I'm trying to see here which side is bigger. So yeah. 9 and 10, that's what is that? That's 19,000 plus 2,300. Okay, and then minus all these figures here, minus 2,850, minus 2,500. I guess it would help if I showed you how to do this, huh? Minus, sorry about that. So what I did was took the 9,000, the 10,000, and the 2,300, and I came up with like 21,300. And then so far I've subtracted out these two numbers here. I forget that the calculator is not always visible. Minus 4,300, minus 350, minus 3,000. I'm right here. Minus 1,000, minus 1,750, minus 995. Gives us $4,555. And again, I'm entering that over on the left side because cash has a normal left side debit balance. All right, so that's it for T accounts.